Our next speaker is Shiva Bhashyam. But before that, I want to recognize our GOPIO Vice President Ram Gadvi is here, and also GOPIO Central Jersey President Kunal Mehta, and of course our the chapter's Vice President Vijay Garg, who has been my co-host all the time whenever we do Zoom. Thank you, Vijay, for all your help. Now I go to Shiva Bhashyam. While I'm saying something about him, Shiva, you can share the screen now. Shiva is going to speak on the importance of financial planning in retirement. He received his undergraduate degree in economics from Tufts University and a master degree in management and finance from London School of Economics and Political Science. Shiva is a certified financial planner, practitioner, accredited estate planner, accredited portfolio manager advisor. Shiva has been a financial advisor with Ameriprice's Financial Private Wealth Advisory Practice, Bhashyam Wealth Management Associate, that's part of the American enterprises which he runs. Shiva has been named as Forbes Best in State Wealth Advisor for 2019 and 2020. Shiva?
Great. Well, thank you everyone who's on the call today. Really appreciate you spending some time. Thank you, Dr. Abraham, for organizing this, and GOPIO members for attending and organizing. As Dr. Abraham mentioned, my name is Shiva Bhashyam. I'm a private wealth advisor with the Ameriprise, and I have offices in White Plains, New York, and Saddlebrook, New Jersey. And I have to apologize in advance. I do have quite a few numbers on the slides I'm about to show. And I realize Friday evening, close to 8 o'clock, I hope I don't put too many of you to sleep here, but I'll try to make it entertaining. So what I wanted to talk about today was basically give an update to what's going on in the markets, because that's certainly, I think, top of mind for a lot of people, business owners, investors, what's happening in the markets. And specifically, I want to do two things. Number one, I want to highlight some of the mistakes that I've been seeing investors make this year, because I'm sure it's not exclusive to them. I'm sure this is something that hopefully we can all learn from. And number two, I want to talk about how to think about your own portfolios, whether it's for retirement or education savings or buying a house or whatever it is you're saving for. Think about those portfolios in the broader context of how does it fit into your overall financial plan, and specifically pay a little bit closer attention to how does it fit in to your retirement plan. Because I think one thing is clear is that this year, 2020, has been a very volatile year. Just to lay the context for everyone, in the month of March, when this pandemic, COVID pandemic started, we had a roughly 40%, that's 40% drawdown in the US stock markets, from the highs in February to the low on, I believe, March 23rd. And that was followed by an equally violent increase in the markets in the month of April. I think it was 25% rebound in a 2-week time frame. And so if you guys can kind of remember back to those early months when this pandemic was starting, the level of fear, the level of uncertainty was very high. We had unemployment rates in February at all-time lows, around 3%. And those unemployment rates spiked to 15% in April. It's really only 8 weeks, which were the highest since the Great Depression. Similarly, we saw GDP in the second quarter, that's gross domestic product, measure of economic activity in the United States, fall 30% in the second quarter of this year, okay? So this year was quite scary, particularly in the first quarter. However, because of the actions of the Federal Reserve, because of the actions of Congress and their fiscal stimulus, and frankly, because of the resilience of many American businesses, both large and small, the economy has been able to recover somewhat, not all the way, but to a great extent, from the lows that we saw in March and April. To put it in perspective, the unemployment rate, while it peaked around 15% in April, is now down to around 6%. Consumer spending is back to almost the level it was in February, pre the pandemic. Consumer savings is actually at all-time highs. And so we've seen the economy be very resilient in spite of all of the headwinds, and that has translated into financial markets as well, where we've seen the, for example, the S&P 500 pretty much make up all of the losses that it incurred in March and April, and is back at all-time highs. In fact, if you were to close your eyes in January and open them today, most major indices for US and even most major international indices are up around 10% or more this year. And so one of the things I have on the slide here is just a graph, a long-term graph of the United States stock market. And I put it here to highlight the fact that even though over short periods of time, the markets go up and down, over longer periods of time, the being invested and staying invested is one of the best ways to compound your wealth over long periods of time. And the key thing I want to highlight is that what I found most investors who handled the initial few months of this pandemic successfully framed their investing slightly differently. Instead of looking at their portfolio and framing it in terms of dollars lost and percentages lost, they looked at their portfolio and framed it in terms of what are the goals that I'm saving for and what are the timeframes associated with those goals. It's a subtle shift, but it has a profound impact in that it reorients your time horizon to thinking longer term. There's a lot of academic studies that suggest that under periods of extreme stress and uncertainty, which we certainly experience this year, people's time horizons shrink. To put it simply, when the markets are volatile, you can't see past your nose. And combined with that, people's ability, or rather their desire to increase their level of control also increases. So when you combine that, when you compress time horizons on decision making, when you increase your desire to have control over a situation, you lead to doing things like sell. And actually this year, that's exactly what happened. So on this chart here, what I'm showing is the level of money market assets held by investors. And you'll see in this area around the March timeframe when COVID first started, the dark line represents money market assets went from just under 2.5 trillion to just over 3.5 trillion in basically like 2 weeks. That's a over 40% increase. And the light blue line is the interest rate on cash or money markets, which essentially went to zero. So you can see that in that time frame, when we know that it was critically important to focus more on your goals and your time horizons, investors by and large did the opposite and moved to cash. In fact, I was reading one industry publication not too long ago that highlighted the fact that at Fidelity, 1/3 of retirees sold all of their equities in March. Okay, 1/3 of retirees who have money at Fidelity sold all of their equities in March. And many of you on the webinar today may know people like that. And unfortunately, that's a devastating move for two reasons. Number one, obviously you lock in those losses, and unless you're very quick to get back in, you probably miss the increase in prices. But number two, in retirement, one thing that's critically important is income. And when you lock in a big loss like that in retirement and you continue to draw income from your portfolio, it drastically reduces the probability that your portfolio will survive as long as you do. Okay, so I'm just going to highlight a couple of kind of numbers just to drive this point home. Here, there's an old saying for those of you who've been investing a long time, you may know it. It's that time in the markets beat timing the markets. Time in the markets beats timing the markets. And this slide kind of illustrates that. This takes data going back 40 years, so basically 1980 to 2020. And if you missed just 10 days 10 of the best days in those 40-year period, your annualized rate of return goes from 11 to 8.9. That might not seem like a big number, but what that translates into is, for example, if you use absolute dollars, if you had $100,000 in 1980, if you earned 11%, if you earned 8.9% on that $100,000 for 40 years, you had $3 million, which is not a bad number. But if you earned 11% on that $100,000 for 40 years, you had $6.5 million. So the difference there is $3.5 million, okay? So that's an enormous difference over a 40-year time frame. So just by missing 10 days over 40 years, okay? And this is another chart that basically explains the same thing. You may say, okay, well, you know, don't want to miss the best days, but what if I just miss the worst days? Well, unfortunately, it's not that simple. You know, what the chart I have on the slide here illustrates is that the best days in the markets happen in very close proximity to the worst days. You know, unfortunately, that's just how the markets work. That if you are going to be out of the market during the worst days, then you're probably going to miss the best days too. And that's basically what we saw in March, where we had an incredibly fast rebound right after the lows on the 23rd. This is a kind of an important chart. I kind of want to highlight this. Now, the numbers on the chart really aren't that important. The point I want to illustrate is as follows. What this chart represents are the distribution of returns over different timeframes. So on the left-hand side, we have the distribution of returns over a 1-year rolling period. And all the way on the right-hand side, we have the distribution of returns over a 20-year rolling period, okay? And if you just focus on the black bar in the middle of each of these, this represents kind of your typical 60-40 portfolio. It's 55% stocks, global stocks, 40% bonds, and 5% alternatives. What you see is over a 1-year period, the returns for the people who invested at exactly the right time, so the lucky investors, can be as high as 40%. And the returns for the investors who invested at exactly the wrong time, the unlucky investors, can be as low as negative 25%. But if you change the time horizon to a longer time horizon, look at this 20-year number, what you notice is that even if you're the most unlucky investor and you put all your money in the markets or into a diversified portfolio right before Lehman Brothers collapsed in 2008, your rate of return over a 20-year period is still around 6% per year, okay? And if you're the most lucky investor and you put all your money in the markets in March of 2009, right at the bottom, your rate of return over a 20-year period is actually just about 7.5%. So the distribution, the difference between the best and the worst shrinks the longer your time frame. And so this goes back to this idea of it's not timing the markets, it's time in the markets, okay? So a couple of key takeaways, try as much as possible to keep your emotions in check, ensure that you're diversified, properly diversified. I'll speak about that in a minute, and be disciplined. And the last thing I'll say is you want to align your financial strategy to your broader financial plan and your goals. And so what does that mean? So I don't know if I mentioned in the beginning, Ameriprise is actually the largest financial planning company in America. And so they spent a lot of money and time and effort trying to figure out what is an easy way to communicate a retirement plan to someone in a very simple and straightforward way. And what they came up with is this pyramid. Okay, it's called the Confident Retirement Pyramid. And essentially you start at the bottom and move to the top. What it basically says is the following. When you're thinking about your own retirement plan, whether you're doing this yourself or working with an advisor, the first thing you want to do is make sure that you have an ability to cover your essential expenses. So those are things like your mortgage, if you still have one, your property taxes, utilities, grocery bills, et cetera. Those expenses that you're always going to have. You want to match those up with a guaranteed source of income, whether that's Social Security, interest from CDs or treasury bonds, or some sort of guaranteed annuity income product. That's step number one. Number two is when you think about the lifestyle you want to lead in retirement, whether that's traveling, visiting grandchildren, buying a second home, whatever it is, visiting India, you want to make sure that you have a portfolio that's diversified, not just by asset classes, so stocks and bonds, et cetera, but also by time horizon, risk tolerance. Those two things go hand in hand. You generally want less risk tolerance with shorter time horizons, more risk tolerance with longer time horizons, and tax treatment, okay? So if you organize your portfolio accordingly, you can ensure that your lifestyle goals that you want to maintain in retirement have specific portfolios allocated for that. The third thing is called preparing for the unexpected, which basically means, when you retire, it doesn't mean that bad things still can't happen. And so you want to ensure that you have appropriate emergency funds, cash reserves, in place. You want to think strategically about the inevitability of your health and the decline of your health. And so thinking about risk management for long-term care, whether that's depending on your kids, paying for it out of pocket, or transferring the risk to an insurance policy, those things become critically important. And lastly, you want to leave a legacy. So leaving a legacy, once you've accomplished these first three elements of the pyramid, thinking about your own estate plan, to Michael's point, charities you want to give to, how do you want to support your grandchildren or great-grandchildren, those things become incredibly important. So I urge you, for those of you who are either have a plan in place right now or thinking about your own retirement plan, think of it in this framework with these 4 steps of the pyramid. I think it can add a lot of value.
Thank you, Shiva. Prasad, we can take a couple of questions if there are any.
Yeah, I can ask like in a couple of questions that came up in my mind while Shiva, it is a great presentation by you, and thank you for that. And I'll ask you basic questions to make sure that all my the participants can understand what you are talking about. When you say like, and when you are investing in the markets, your dollars of the loss or the percentage of the loss is not much, but what about your goals and time frame? So isn't it when we are investing in the market, our goal is to make money? And regarding the time frame, it doesn't matter whether you're in 25 or 50. Isn't it the same goal that we want to make money in the market?
Yeah, that's a good question. You're right. Obviously, the reason why you take risk with your money and invest your money is to earn a rate of return, right? That's fundamental to investing. However, what I'm trying to draw a distinction of is this idea of having an appropriate portfolio that's diversified and matching a risk tolerance that you're comfortable with the time horizon that you're investing for. Because to your point, Prasad, investing is not a straight line. You don't make money in a straight line. There are lots of ups and downs that come with investing. And in my own practice, what I have observed is that the investors who have the fortitude to have a bigger picture in mind, a bigger purpose to the reason why they're investing, are the ones who have the willingness to sit out the volatility, to ride out the volatility to get to the other side. It's often not, one of the things I always try to convey to my clients is that the biggest obstacle in investing is always yourself. It's not necessarily picking the right security or making sure you have the right, asset allocation framework in place. While those things are important, they're not the biggest hurdles. The biggest hurdles is always internal, it's always individual. And what we see is when we have these big market moves, when we have this big volatility because of XYZ reasons, the inability to weather that, those two things I was highlighting, the desire to have more control over the situation, which is inherently not in your control. And also the inability to see think about your goals in the appropriate time horizons, that's really what trips people up. And so Prasad, for those people who just stayed the course this year, they're all doing reasonably okay. For those people who have the mindset of, of course, the goal of investing is to make money, but to make money on, what time frame? I think that's what I was trying to.
I think what we will do, Prasad, we had to have the next speaker now. After the formal presentation of everybody, those who want to stay back, they can ask question one-to-one. I will open everybody to ask questions at that time.